Oh, I'm sorry. I thought it was on. The conference is still in existence, no bill having been reported, and I now move reconsideration of the acceptance of the title involving the pay-for in the House. All those in favor of reconsideration say aye. Aye. Opposed, no. The ayes have it. It's reconsidered. Senator, did you have a...
Yes, Chairman Frank.
The senator's going to make a motion, and then we'll debate it.
I know. I just wanted to acknowledge and tell my members that our time for debate will be when it comes back.
Right. The Senate's going to send us an offer, and then it'll be open for debate as to whether or not we accept it. Senator?
Well, thank you, Mr. Chairman, and let me thank all of our fellow conferees and others who have gathered together. I appreciate it very, very much to reopen the conference for the consideration of a new proposal on a pay-for provision in the bill. As no doubt all in this room and others have been aware, there was a reaction to the pay-for proposal. I happen to think what the House offered made sense, would work, but obviously having that opinion yourself doesn't necessarily guarantee that you're going to build up the necessary support to be able to succeed with a piece of legislation. And because there was a reaction to it, we've tried to come up with an alternative idea that would reduce those concerns, allow for us to meet the obligations under this bill. We had, of course, met them earlier. You may recall we originally had in the Senate version of the bill a ex-ante fund of some $50 billion. The House had a larger provision of $150 billion, which would have left the legislation in the black in our bill by about $20 billion thereabouts. I don't know what the impact was on the House version of the bill. But our colleagues felt that that was sitting out there. Optically, it looked like a bailout fund, and as a result, Senator Shelby and I offered an amendment which struck that provision in the bill on the Senate side. And we moved through the Senate without a pay-for in the provision. The House obviously requires pay-fors. I think we would have faced strong opposition had they come back without any pay-for in the legislation, even though the Senate didn't necessarily require that per se. And so coming back with an alternative pay-for is what brings us here today. And what I'm going to propose, and the language specifically is before your legislative language. Let me just briefly describe what I'll be offering as an alternative for the pay-for, if I may. One, it removes the financial crisis special assessment, which is our section 1601 and 1602 of the conference report. Number two, it effectively ends the TARP program. It amends Title 13 by prohibiting any new programs or initiatives under the TARP, reducing the total amount of TARP authority from $700 billion to $475 billion, basically only what has already been authorized under the TARP. And it keeps the provision in the conference report that prohibits TARP repayments from being recycled into new obligations. In effect, I think the legislation calls for that date to be actually June 25th in the legislation, so it even predates our meeting here, so there are no doubts or concerns about whether or not there'd be any new obligations under the TARP program. Secondly, it strengthens the FDIC's Deposit Insurance Fund, amending Title III of our proposed conference report. The Senate offer would increase the statutory minimum target for the FDIC's Deposit Insurance Fund from 1.15% to 1.35% of estimated insured deposits. The FDIC would have almost an additional 4 years until September 30th, the year 2020, to meet the higher minimum targets. Furthermore, in setting the assessment necessary to raise the minimum target from 1.15% to 1.35%, the FDIC shall fully offset the effects of this requirement on insured depository institutions that have less than $10 billion in assets. In other words, banks with under $10 billion in assets will not pay for this increase. Now, the last time, of course, the conference met, as I pointed out earlier, we adopted a pay-for provision to offset the cost of the bill by imposing a financial crisis special assessment, as my colleagues know. We have heard, of course, from a number of our colleagues, I mentioned earlier, about the concerns of this provision, and so we proposed, as I said, to strike it, Section 1601 and 1602, and replace it with the two pay-for provisions that I've just briefly described. As I said, one ends the TARP program, the Troubled Asset Relief Program. The other would be to strengthen the Deposit Insurance Fund of the FDIC. In fact, to make the point here about the FDIC, I'll ask consent that a letter dated June 29th from the chairperson of the FDIC sent to myself, Congressman Chairman Frank, Senator Shelby, and Senator Backus reads as follows. Thank you for interest in our views regarding increasing the deposit insurance fund ratio to 1.35%. Federal deposit insurance promotes public confidence in our nation's banking system by providing a place for consumer funds. Deposit insurance has provided much-needed stability throughout the crisis. Moreover, insured deposits provide banks with a stable and cost-effective source of funds for lending in their communities. Importantly, the DIF is funded by the insured banking industry. A key measure of the strength of the insurance fund is the reserve ratio, which is the amount in the DIF as a percentage of the industry's estimated insured deposits. Current law requires us to maintain a reserve ratio of at least 1.15%. One of the lessons learned from the current crisis is that a minimum reserve ratio of 1.15% is insufficient to avoid the need for pro-cyclical assessments in times of stress. One of my first priorities when I assumed the chairmanship of the FDIC in June of 2006 was to begin building our reserves. Regrettably, there was insufficient time before the crisis hit. Indeed, we started this crisis with a DIF reserve ratio of 1.22% as of December 31st, 2007. Beginning in mid-2008, as bank failures increased and the insurance fund incurred losses, the fund balance and reserve ratio dropped precipitously. The reserve ratio became negative in the third quarter of 2009 and hit a low of negative 0.39% as of December 31st, 2009. To date, we have collected more than $65 billion in assessments and are projected to collect another $80 billion by 2016 to the reserve fund. Given this experience, we believe it is clear that as the economy strengthens and the banking system heals, the reserve ratio needs to be increased. In fact, our board has acted through regulation to target the reserve ratio at 1.25%, and a further increase to 1.35% is consistent with our view that the fund should build up in good economic times and be allowed to fall in poor economic times while maintaining relatively steady premiums throughout the economic cycle, thereby reducing the pro-cyclicality of the assessment system. Please let me know if you have any questions or would like to discuss further. Signed, Sheila Bair. I apologize for taking the time to read that, but I thought it was important to note that this was the insistence or request, by the way, of the FDIC, not just a legislative initiative. So the additional resources that are provided by this provision, I think, along with the of ending the TARP program, which I presume would be warmly received, given the strong suggestions. In fact, we had an amendment that was, I think, adopted unanimously, if I'm not mistaken. Maybe there was a vote on it, offered by Michael Bennett of Colorado, Senator Bennett, that actually offered to proposing to ending the TARP program, but it was over a longer period of time. So we've already expressed our views on that, at least to one degree or another. This obviously truncates that time, as I said earlier, by having the date of termination actually predate even the gathering here today. So that is the proposal, I say to my Senate colleagues, that we'd like to send to our colleagues in the other body for an alternative pay-for provision, which I would hope would be warmly received as an alternative and better idea. Whether you like all the bill or not, as a better alternative than the one that was adopted in the wee hours of Friday morning when last we gathered at this conference. Now, with that, let me turn to my colleague, Senator Shelby.
Thank you. It appears to me that Chairman Dodd is proposing a budget gimmick to expand deposit insurance in order to get a better score from CBO over a limited time frame, or so-called budget window. Of course, deposit insurance, if it truly is insurance, does not create resources. As we saw in the recent crisis and the S&L crisis before it, the deposit insurance fund can rapidly be depleted and in need of replenishment. It can quickly become a drain on funds as opposed to a source of funds. If we can create government resources by raising the cap on deposit insurance, arguably, we could drive deposit insurance up even further and pay for any number of federal programs. I believe that we need answers from the Congressional Budget Office concerning the assumptions used in scoring this legislation. For example, look at the year-by-year CBO assumptions about outlays of the Orderly Liquidation Authority on page 5 of the score that CBO published yesterday evening. It shows outlays peaking at $4.4 billion in 2012, followed by variations up and down in the years that follow. For example, estimated outlays go from $2.2 billion in 2017 down to $1.8 billion in 2018, and then go back to $2.3 billion in 2019. How does CBO determine that there will be fewer orderly liquidations in 2018 than in the year prior or the year after? Where do these numbers come from? We should all ask this. What are the assumptions? We should ask that. I do not believe we have adequate information about these budgetary numbers. This bill has become, I believe, all about politics and budgetary smoke and mirrors, and not about sound financial regulatory policies or taxpayer protection. Mr. Chairman, I would urge my colleagues at the right time to again vote against this legislation.
I thank you, Senator. By the way, our intention here is to, and I say this in advance to my colleagues, and I know there may be some effort to limit our gathering again to this one area of the bill in the pay-for section, and not to open up the entire bill for other considerations. But I realize here we're in conference, and others may make an effort to do so, and I want to certainly give my colleagues a chance to respond to this or whatever other ideas they have. Senator Crapo.
Mr. Chairman, before making comments, first of all, just a question. Do you have some kind of an analysis or some kind of a summary that could show us just how it is that the proposal you have before us, by ending the TARP program and then by increasing deposit insurance premiums, addresses the $19 billion shortfall?
I'll be happy to. In fact, I may ask staff. Where's Charles? I want you, Charles. This is Charles Yee. I can do it myself, but let's have Charles come in and just go through it, why it's less than $19 billion, CBO scoring, the TARP closure at $11 billion. We got a CBO report specifically on this, and the resources that come as a result of the change in the FDIC. But Charles, why don't you take this microphone and answer Senator Crapo's question.
Right. The CBO estimates that the effects of these two provisions in the Senate offer combined would be enough to fully offset. Not only that, would actually result in net reduction in the deficit. The ending TARP, the first provision, is estimated to be somewhere around $11 billion, and the DIF provision, that results in a savings of about $5.7 billion. And on top of that, the existing provision in the conference report that makes permanent the increase to $250,000 in the deposit insurance, that has a net savings effect of about $8.7 billion, I believe. So CBO has signed off on the combination of this language as fully offsetting the cost of the bill.
Well, Mr. Chairman, could I ask another question?
Certainly.
Weren't all TARP funds supposed to be returned to the Treasury for deficit reduction?
Well, that's what happens with this. In fact, is that correct? Say, Charles?
Yes.
That all of those end up going back. It's ending the program.
And then, well, we'll get into that in a minute. But then secondly, with regard to increasing deposit insurance premiums, again, are not the premiums paid into deposit insurance intended to be utilized for deposit insurance and not utilized for other congressional outlays?
Well, that's correct, but this is, in other words, to have, from a budgetary standpoint, to have the pay-fors and the House requires, that this qualifies as providing that kind of an offset. Is that correct?
Yes.
Yeah.
And then we could pay for a whole lot of spending if we just increase the deposit insurance.
Well,
further.
but you don't want to do that, obviously, and we're exempting the smaller institutions under $10 billion, so they won't be burdened by this, and that was at the suggestion of the FDIC as well. Are there other comments that my colleagues? Yes, Senator Judd Gregg.
Well, Mr. Chairman, I've been chairman of the Budget Committee, and I've been the ranking member of the Budget Committee. And in my experience, having seen about as many tricks, games, smoke, mirror, misleading, misdirected shell activities, this ranks right up there at the top of the list for pure deception relative to treating the American taxpayer in an inappropriate way and significantly increasing our deficit and our debt. The law is pretty clear. The law said, I know this because I wrote it, the law said the TARP funds will go to reduce the deficit and the debt, now as they were paid back. Now, why do we say that? Well, those of us who were sitting around that table, and you were there, and Congressman Frank was there, recognized that we were doing something extraordinary. We were going out overnight, basically, and borrowing $700 billion, most of it from the Chinese, which our people were going to have to pay back, the American people. But we expected, and we demanded in that bill, that the banks pay the money back. And we also decided, well, as this money comes back in, we shouldn't spend it. We should use it to pay down this debt which we just incurred and we owe to the Chinese or Saudi Arabians or whoever lent it to us. Because it wasn't right to go out and borrow that much money, then have it be paid back and have it be spent. What was right was to pay down the debt that had been created to address this crisis. So that's what we did. And the money that's come back in so far has been used to pay down the debt. Unfortunately, all the money hasn't come back yet. The money from the auto industry hasn't come back. The money from AIG hasn't come back. The money we sent out to the banks actually has come back with interest. We've made, I think, somewhere in the vicinity of $17 billion on that money. And it's gone to reduce the debt like the language of the law said. Now you come along with this little bit of gamesmanship, and you're terminating TARP, which it should be, and I've voted to do that a number of times, but you're taking the savings from terminating TARP, which CBO scores at about $11 billion, at least that number's honest, and you're spending it. You're spending it. You're not using it to reduce the debt or the deficit. You're spending it in this bill. What an affront that is to the American people who we gave our word to we were going to use that money to reduce the debt. Let me read the language of the bill. Protecting the interests of the taxpayers by maximizing overall return and minimizing the impact on the national debt. The money paid back shall be paid into the general fund of the Treasury to reduce the public debt. Now we're going to use a little bit of bait and switch here by claiming that money that hasn't yet been spent on TARP, which was obligated and authorized solely for the purposes of being spent on TARP, when we terminate TARP, can suddenly be spent for some new program. If that doesn't go against the intention, the purpose, and the integrity of the law that we passed earlier, called TARP, I don't know what does. And the American taxpayer should be affronted by this little bit of sleight of hand and gamesmanship. Even the president should be, because it was the president who on the floor of the Senate said, finally, I said that if American taxpayers are financing this solution, then they have to be treated like investors, and they should get every penny of their tax dollars back once the economy recovers. The last part is important, because it has been the most misunderstood and poorly communicated part of this plan. This is not a plan to just hand over $700 billion of taxpayer money to a few banks. If this is managed correctly, and that is the important if, we will hopefully get most or all of this money back and possibly even turn a profit on the government's investment. And every penny of that will go directly back to the American taxpayer. It will be used to pay down the deficit and the debt. That's what the president said. That was his understanding of this bill. That was my understanding of this bill. That was the American people's understanding of this bill. But now we have a new understanding of this bill. There's $11 billion, according to CBO's score, that's sitting here. Let's spend it on some other program. And then we have this FDIC gamesmanship. I mean, what a piece of misleading, misdirection, financial management this is. You're going to raise the FDIC fees, and then you're going to score them and spend them under this bill, when those fees are supposed to be being used for the purposes of taking care of protecting the banking system and making it safer and sounder? How do you do that? How do you spend the money twice? You spend it in this bill, and then when a bank goes under in, I don't know, in New Hampshire or in Connecticut, and the people who have their savings, their entire life savings in that bank, expect the FDIC to come in and protect them to the extent of $250,000? You just spent the money on this bill. How do you do that? How do you spend the money twice, Mr. Chairman? It's impossible to spend the money twice unless you're in the United States Congress and you ignore the rules of financial budget. If we did this in a private sector action, we would all be in jail. This is fraud on the American taxpayer. That's clear and simple. That's all it is. And to come here and claim that this is a responsible way to address this issue, well, I guess that's why we've got $13 trillion worth of debt, and we're headed towards doubling it in 5 years and tripling it in the next 10 years. Because this is not responsible, this is profligate, and it's not even honest, because it's misleading. It's saying one thing and doing the exact opposite. Spending money twice. Violating a law that we wrote, not in the literal sense of the law, no. You can probably get an attorney to say, well, the unobligated funds were never listed in the language of what goes back to pay down the debt. It's just the money that comes in. Well, yeah, I suppose you can get an attorney to parse the words that way, but everybody understood, beginning with the president, right down through that person on Main Street who paid the bill for the interest on the notes that the Chinese hold, that we want to pay down that debt. That should be our goal. And this not only doesn't do it, it does the opposite. It spends that money. So I find this to be unconscionable, inappropriate, and clearly misleading, to be kind. So I have an amendment at the appropriate time to actually do this the right way, to not use TARP funds and claim that we are then reducing the debt when we're actually spending the money and violate the law of TARP, and not use the FDIC funds and spend them twice. The amendment I offer will suggest that we use the stimulus funds, which actually are available to us and which could be spent on this initiative and which would be an honest and fair offset. And I will make that proposal at the appropriate time, Mr. Chairman.
Mr. Chairman. Senator Reid. Mr. Chairman, just quickly, I notice some disquiet by my colleagues, and I think it's because this bill represents one of the first major initiatives that we've taken in the area of financial regulation that's actually paid for. Over the course of the last several years, particularly beginning in 2000, many initiatives were not paid for. Tax cuts, Part D, Medicare, 2 wars. So the idea of actually paying for something, I think, comes as a shock to people here. As I understand the previous provision that we are now replacing actually called for a tax on financial institutions that ultimately would go towards deficit reduction at the end of its term. And yet that's being rejected because some of our colleagues consider that to be an inappropriate way to balance the budget. I think it's ironic because the tax burden on the large institutions that was proposed initially represents a fraction of the budget of the bonuses that are annually handed out by financial firms. And the rationale that by taxing these firms will deprive them of the capital to invest in the economy, the same logic applies to those bonuses. When those bonuses go to rewarded, compensated individuals, that money too cannot be spent on small business loans, etc. So I just find it hard to understand first why we're rejecting the initial proposal. But second, I think this proposal does what has not been done enough over the last 10 years. It actually pays for, under the CBO scoring, which is the official scoring, a major initiative. Final point I'll make is all of this discussion about this PAYGO, if this legislation fails on PAYGO, the winner is Wall Street. Nothing will have changed. The rules of the game will continue as they was that led up to the crisis. Derivatives will be unregulated. Responsible capital requirements will be set aside, and the winner will be Wall Street, not Main Street or the American people. I think this is, I would have preferred the first proposal, but I think this proposal first pays for it, Second, it does so in a way that's recognized by the Congressional Budget Office as appropriate to cover the pay-go rules, and I would urge passage.
Well, let me underscore that point as well, and the strong emotional response to this. I almost feel like no matter what we came up with here, again, there are people who just fundamentally disagree with this legislation and opposed to the whole idea of the kind of reforms. That's a legitimate debate. There's ideological differences. There are people who would put different emphasis on different things. I think every one of us at one point or another, including our House conferees as well as here, if we could write the bill alone, would probably write a different bill. But we write it in a collegial fashion here, trying to take into consideration the various interests and concerns of our constituencies around the country with the goal in mind, as my good friend from New Hampshire has identified, that fall days in 2008, in which he and I worked closely together along with others to come up with a solution that avoided the kind of collapse that we were warned could occur. We did so in a way that was painful for people. I happen to agree with the observation that's been made. Had we not acted as we had, I think the country would be in much deeper and dire straits than we confronted as a nation. But clearly the idea, after all of this, and the efforts to come together to try and address those concerns so we don't find ourselves once again back where we were in the fall of 2008 with nothing having changed whatsoever and all of the vulnerabilities. What is our response to the American people when they ask, have you done anything about rating agencies? Have you done anything about trying to streamline the regulatory process, getting greater accountability? What have you done to see to it that we're going to have the kind of response out of the Federal Reserve, to see to it we have the oversight and ability to identify crises before they metastasize into situations that put our entire financial system, maybe that of the world, at risk without asking? There's a long list of things in this bill that I think strengthen our economy, make the economic structures of our nation reflect the 21st century in which we reside and live, and share the responsibility of moving forward. And so coming up with a pay-for in all of this is not easy. I'll acknowledge that. It's difficult. But nonetheless, we bear that obligation to do so. And by reducing the obligations from $700 billion, initially $750 billion, down to $475, ending that program, which many have talked about, I thought would be more warmly received. And secondly, by relying on what is needed, again, to replenish the FDIC. What's the alternative? To borrow from the Treasury when we end up not having the resources at the FDIC to keep financial institutions operating from a Friday to a Monday, as we've been able to do under the Federal Deposit Insurance Corporation? I don't see that as an attractive alternative for us. And so by replenishing that account, getting the scores we need to accommodate the budgetary concerns, seems to me the wise way to proceed on this. Now, again, that doesn't satisfy those who are opposed to the bill. I understand that I'm not going to solve that problem by coming up with an alternative pay-for that may be more acceptable to colleagues who end up having to vote for or against this legislation. So that's the reason for it. Again, trying to come up with an answer here that makes sense to people. And I know there are different ideas that people still want to address, and I'll be glad to entertain those ideas, but at some point we need to move on this as well.
Mr. Chairman.
And I know someone had an amendment, or
Mr. Chairman.
Senator Gregg, or who is it? Senator Corker. Senator Corker.
Mr. Chairman, I've been relatively mild-mannered through this conference, and have tried to offer amendments that were not messaging amendments, but amendments to improve the bill. Worked with people from the other side of the aisle, Mr. Peters and others, to do that. But I have to tell you, Mr. Chairman, the comment you just made is one of the most disingenuous comments I've heard made during this conference. That there are some here that are ideologically opposed to reform. That is absolutely not true. And you find yourself wrapped around the axle right now. No, let me finish.
Ideologically opposed to this answer on our reform.
No, that's not what you said. Mr. Chairman, I'm going to tell you something. You've got a group of people over here who have worked hard to come up with a bill that makes sense, and y'all are wrapped around the axle right now trying to solve this problem because you have only enough votes to pass it, because you have tried to press the envelope, create a bill that is more partisan than necessary, when you knew you could have had a bill that had 75, 80 votes and lost people on the right and left to do so. So, Mr. Chairman, when you say that there are people in this room that are just fundamentally opposed to financial reform, that is absolutely disingenuous. I want to say to the gentleman from Rhode Island, the fact is, Wall Street's going to be fine. And for y'all to put on this charade that this is about Wall Street, come on. Wall Street's up. They're loving it. They've got teams of people to work with regulators. They know they're going to be fine. It's the community banks around this country, and we all know this. It's the community banks that are going to be hurt. Community banks don't have teams of compliance officers to deal with the thousands of pages of regulations they're going to be dealing with. So, Mr. Chairman, I've been pretty mild-mannered, but that is absolutely categorically untrue. And I wonder if Senator Bennett, I wonder if he's aware, I know he passed the Pay It Back law. I wonder if he's aware that you're taking $10 billion of the legislation that he passed to spend someplace else. And I wonder if some of the Republicans you're talking to about getting to 60 votes are aware you've created a Class Act type pay for, just like we did in health care. We created a long-term care insurance policy that we knew was never going to be funded, and we used that money to pay for a bill. That's the same thing we're doing with this FDIC fund. So, Mr. Chairman, I have deep respect for the way you and the chairman from the House side have conducted the conference, and I appreciate both of you having a conference that was a real debate. But to say that there are people here that are fundamentally opposed to reform is categorically untrue. And, Mr. Chairman, I just have to tell you what we're opposed to is the fact of what we've done in this bill to not address the core issues but have an overreach in so many areas that were unnecessary on behalf of a political agenda that has nothing to do, in many cases, with financial reform.
Further comments on the bill? Senator Crapo.
Mr. Chairman, I want to follow up a little bit on these comments because, again, just to make it clear as we discuss this proposed change, the problem that has come up with the bill is that it spends more money, and the provisions that were adopted last Thursday night in the late hours of the night to address that were not acceptable to many of the other members of the Senate, and I assume the House as well, as they looked at the increase in expenditures. So we're back at the table to try to deal with it. And what is the proposal that we have? I have to agree that it is smoke and mirrors in the budget at the extreme. First, we are taking TARP funds that were promised to the taxpayer that they would be utilized for the purposes of the TARP program and then repaid to reduce the deficit. And in response to my question earlier about that, wasn't it the case that the TARP funds were to reduce the deficit? The answer was, yes, these funds are going to be used to reduce the deficit. Well, they're going to be used to reduce the deficit after this bill has increased the deficit, and they're going to be used to partially repay the increase in the deficit that this bill has generated. That's not what we told the American people. We didn't say, you know what, we'll use these TARP funds to reduce spending that we're going to do in the future. We said we'll use these TARP funds to reduce the deficit when they come in, not to offset other federal spending. But that's exactly what's being done with these TARP funds. They're being used to offset new spending. And that is exactly in violation of what we promised each other and the American people when TARP was passed. Secondly, with regard to the Deposit Insurance Fund, simply increasing the premiums in the Deposit Insurance Fund will increase the fund available for the Deposit Insurance Program. And those funds are intended, it's in my mind, you'd treat it like a trust fund. We are helping to boost up a trust fund, a deposit insurance fund, that's got a specific purpose in law to help protect against deposit failures when banks fail, and to help provide the insurance for those whose funds are in those banks that fail. And yet we have a budget rule here, and I'll use that word politely, a budget rule, that apparently allows us to spend money in other programs if we increase the amount of money in the deposit insurance program. If that kind of a gimmick could have been used, if Congress had known that before today, can you imagine the amount of federal spending that Congress would have tried to get away with just increasing the money in the Deposit Insurance Fund and then offset it against any kind of spending that we'd like to get going at? That's what we're doing here in this bill. We ought to face the cost of this bill properly and deal with it properly. The chairman asked, well, what's the alternative? The alternative, Mr. Chairman, is to offset the spending by cutting spending somewhere else in the budget. We have a $3.8 trillion, or whatever the number is today, budget. we ought to be able to find $19 billion in it somewhere if in this bill we propose to increase it yet again by another $19 billion.
Further comments? Amendments? Who has amendments? Senator Gregg, you have an amendment? Clerk will report the amendment. Are there copies of it, Greg? Judd?
I think they're being passed out.
Strike section 1601 and 1602.
I'd ask unanimous consent that the amendment be considered as read. First off, let me join with Senator Corker in his concern and his praise. I do believe this conference has been handled in an open manner. It's been very interesting to participate in it.
I'm sorry. I'm having a hard time hearing you, Judd.
Oh, I'm sorry. I was praising you.
What was he doing?
I knew you'd want to
I couldn't hear you. I'm sorry.
It has been handled
that
in an
if
open
you'd like.
manner, and it has been a fascinating experience, and certainly last Thursday night was most interesting. And the chairman has, throughout this process, been extraordinarily fair in at least soliciting our thoughts, if not necessarily accepting them. And certainly early on, we had some good working groups going on our side. That's why I have to also associate myself with Senator Corker's comment that really on our side of the aisle, it's not opposition to financial regulatory reform. It's a disagreement with the way this bill evolved and came forward. But that's not what this issue right before us today is. Our genuine desire to accomplish financial regulatory reform is almost irrelevant to this issue before us. The issue before us today is whether we as a Congress are going to continue, and I guess that's why I get so agitated about it, because I've put up with so many years of this, are going to continue on this path of saying one thing to the American people about fiscal discipline and then doing the exact opposite. In this instance, we're saying that we're going to pay for $19 billion of cost in this bill, and we're going to meet the pay-go rules of the House. Doesn't apply to the Senate. And yet, at the exact same time, the proposal that's being brought forward double counts and double spends money, and then spends money that is specifically earmarked to reduce the debt. And so we are saying to the American people, we're going to pay for this, but we're really not going to pay for it. We're going to use an account which is supposed to be a trust account, the FDIC account, to offset other spending. And we're going to use an account which was set up for the American people with a commitment to the American people that it would be used to reduce the debt for new spending. And then we're going to call ourselves fiscally disciplined when we do those two things. And we do this, this is $19 billion, which is a lot of money. That would run the state of New Hampshire for like 3 years. I mean, it's a fair amount of money in New Hampshire. But we do this for tens of billions of dollars almost on a weekly basis around here, of gaming the American people on the issue of fiscal responsibility. 3 months ago, there was a pay-go bill passed in the Senate and in the House and signed by the President. There was great fanfare about it, great fanfare about the pay-go bill. Since that pay-go bill passed, we have either passed or put in the pipeline $200 billion of spending that violated the pay-go rules, the purposes of pay-go, that got around it, gamed it, and added to the deficit and the debt. $200 billion. And now this is going to be added on top of that if it's done this way. So it shouldn't be done this way. If you're independent of whether you agree with this bill or not, we ought to at least agree that when we say we're going to pay for it, we actually pay for it with real dollars that the American taxpayer can look to and say, yeah, that's a real pay for. It's not money that should have gone to debt reduction. It's not money that is being spent twice. It's real dollars that should be spent to pay for this. So that's why I'm offering this amendment. This amendment essentially says, let's take the dollars out of the unspent stimulus package on a pro rata basis. $18 billion. Let's not do this TARP language. Let's not do this FDIC language. And let's, while we're at it, confirm the fact that when we terminate TARP, and I agree we should terminate it in this bill, that money from the terminated TARP funds will go to debt reduction. So it has 2 steps in it. Pay for this with real dollars from stimulus by a pro rata cut in the unspent stimulus money, some of which is going to be spent in 2019. So we can do it. We can find those dollars. And secondly, let's terminate TARP, and let's actually put the money to debt reduction, to reducing the debt that's on the American taxpayers' back. Take that $11 billion and spend it the way it's supposed to be spent, which is to pay down the Chinese debt, the debt we owe the Chinese.
Senator, both Senators Shelby and then Senator Saxby.
Thank
Chambliss.
you. Mr. Chairman, I'll be brief as I can. I support the Gregg amendment. It makes sense, but everybody here, I think, in the House and Senate knows that Senator Gregg has deep interest and experience on the Budget Committee. He knows a lot about this. He was our chairman of the when we were in control. He's the top Republican on the committee now, ranking. He's a member of the Appropriations Committee and the Banking Committee. And when he's talking like this, I think he's making a lot of sense, and I'd urge my colleagues to support his amendment.
I always think he makes sense, too. Senator Chambliss.
Mr. Chairman, thank you. I'm not a member of the Banking Committee. I have not engaged on a number of these issues that have involved exclusively banking amendments, but you know, this is so egregious. You just can't sit here and let this happen. I mean, Mr. Chairman, this is TARP money, money that was supposed to go originally to solve the crisis by buying the toxic assets that later got utilized to send to banks. But in any event, at the end of the day, one of the reasons that a lot of us voted for that bill was primarily because that money, when it was paid back, was going to reduce the deficit. That money was not supposed to be spent in any other area like we're trying to do now. Secondly, I emailed one of my community bankers today, and I said, here's what's fixing to happen to you, and give me your reaction. And I said, your FDIC rate's going from 1.5 to 1.35. Well, I wish I could read the email I got back, but it would be censored by C-SPAN. But the fact is that if you're a depositor, you're going to be extremely upset when you find out about this. The general public is still mad as hell because the majority party used the student loan program to help fund the health care bill. And people all across America, particularly people who have money that they put in banks, that they know that it's going to be safe and secure because FDIC insures it, should and will be mad as hell when they find out that money that is being spent to insure their deposits is now going to fund a financial bill that frankly does not solve the problem of the issues that caused the financial collapse a couple of years ago. So I think Senator Gregg has got a much better solution. If we've got to have a solution at all to finding this money, I think it's a good amendment, and I think it's one that ought to be supported.
Thank you. Let me just respond briefly, and I'll see if anyone else wants to be heard on the matter before we vote on it. First of all, under the proposal here, I don't know whether my friend from George's bank, the size of the bank, but as you know, that all banks have assets of less or $10 billion or less are held harmless under this at 1.15%. Now, so that this does not increase at all. Now, it may have been a larger bank than that. There are a handful of them in the country that have been adversely affected. But most banks, in fact, the ICBA is calling around in strong support of what we're suggesting here, because obviously the smaller banks who are struggling in some cases out here, and any additional assessments on them would be impose some hardships to them. And so their reaction, at least by their parent organization and community, is in strong support of this. Secondly, there are choices. I mean, first of all, ending the TARP program I didn't think would be met with such strong feelings. I thought this was something that people felt generally ought to be done. And the idea that we're going to take the savings and actually go to deficit reduction is something I'm rather surprised to hear such negative reaction to. The alternative idea, which you have the chairman of the FDIC saying, actually helps replenish the fund. Now, again, the idea of cutting stimulus, again, I know people don't like the stimulus package, but those bridges, those highways, those roads, those jobs, at a time when you have staggeringly high unemployment, trying to get our economy moving again, to actually take the funds from something that may actually get the economy moving in the right direction, has been a long-standing debate over the last number of months. That's a choice people can make. Do we ask these institutions that have the resources to be able to contribute to this trying to solve this problem, ending the TARP program, which I think would be, again, something widely supported, or do we cut into a stimulus package, which is designed to put people back to work in a country that is struggling? That's a choice. I come down on the side of saying that I think we ought to keep the stimulus package moving right and keep people working, get the economy moving right, and ask those who have the resources to be able to afford to pay for this, as well as ending the TARP program, is a better choice to make. But that's the choice we have to make here in terms of going forward with it. So with that, I'll ask
Chairman, can I ask a question?
Certainly.
You've said twice now, I thought the first time maybe you just misspoke, but you just said it again, so I guess you feel strongly this is the way it works. You said you're going to end the TARP fund and use the money to reduce the debt. That's not what this proposal does. It does just the opposite. It ends the TARP fund, but it takes that money and uses it to offset new spending, so that money will not be used to reduce the debt. So I guess my question is how you make that, what is the logic for that statement? Because it's entirely inconsistent with what you're proposing.
It prevents TARP money from being spent. That was the great concern, and it truncates the program immediately, and it can't be used for any other purpose other than the funds that are already presently obligated.
Well, but if you take my language, which I'm proposing in this amendment, it ends the TARP program and actually uses the money to reduce the debt. It does not spend it. Your bill, your proposal spends the money that is energized by the termination of TARP, which is $11 billion. Even there's a $700 billion to $475 billion authorization issue, but the actual score is $11 billion. Now, if you take my language, that $11 billion will reduce the debt by $11 billion. We'll go from a debt deficit this year of $1.4 trillion to $1.390 trillion, which is progress.
Well, I just point out,
$1.3989 trillion.
just point out, CBO is also, as a result of what we're proposing here, over 10 years is a $3.2 billion savings, according to CBO.
What is it?
$3.2 billion.
3.2 billion on
For
what?
10 years, according to CBO, as a result of our proposal.
Chairman.
All right, I will, but let's, at some point, let's vote if we can. Yes, Mike.
I would just like to weigh in here and mainly even to respond to Senator Gregg. As I understand what the response was, it's very clear what they're talking about, and that is this bill increases the deficit by $19 billion. It's that deficit that the TARP funds are being used to reduce. And that is just another way to say what we've all been saying here, and that is that the TARP funds are being used to offset new spending, not to reduce the debt, which is what the promise was to the American people when we passed the law.
I know, but let me again, this has gone on a long time. Let's not forget, we had an ex-ante fund in here that was an assessment on the largest, riskiest institutions. They were put our country in the trouble we're in. That was the proposal in the House and in the Senate. At the request of my Republican friends and colleagues, that was stripped out. That would have given us a resource to pay for this bill and leave us $22 billion, I think the number was, in the black here. At the request of my colleagues to strip that out, I find myself sort of in a catch-22 situation. No matter which alternative we come up with to pay for these things, it's just unacceptable. So I have great friends who I work very closely with on this, but I feel like no matter what answer we all come up with, except the one that would actually cut into the very program designed to help our economy and people unemployed get back on their feet again, is the only answer to this. So again, I respect my colleagues. I respect their point of view. My comments, I'm trying to just understand there are differences here, but we need to vote on this at some point. So.
Mr. Chairman, if I could, I just want to speak in support of the Gregg amendment and would say to you and to the chairman on the other side that I can't imagine after as much work as all of you have put into this, you want to end by having headlines in the paper tomorrow saying you used accounting chicanery to pass a bill. I mean, that's what this is. And Senator Gregg has an amendment that actually pays for it and does it in a real way that Americans can actually understand. And I hope we will support the Gregg amendment. It will solve the problem that you're in. And I support it very strongly.
Well, I appreciate it. And the words chicanery and so forth don't help the debate. There are choices to be made here. And the choice is you've given us is to cut the stimulus package, which puts people back to work. That's a choice. And that's what you're offering. I think the headline ought to be, in a sense, the choice was between cutting jobs for working Americans who are struggling to make their ends meet, or financial institutions which can help us pay for this bill. Now, that's a choice. but I think the choice we're making here is a better choice.
Mr.
With
Chairman,
that,
Mr. Chairman, I just have one more point, just as a technical point, because I think it needs to be in the record, if I could have 3 minutes to make it. And that is that the way the TARP language was created under Section 204, it says that rescissions of any amount provided in this act shall not be counted for the purposes of budget enforcement, which means that we will be violating the law by doing this, in my opinion. And you may find yourself with a legal issue on top of just you're obviously violating, I believe we're violating a commitment we made to the American people that this money would go to debt reduction and not to creating new program. But I just wanted to make sure the record was clear on that, just in case. Thank you.
Okay, the members are entitled to their opinion as well. Clerk will call the roll on the Gregg amendment.
Mr. Chairman?
No.
Mr. Chairman, no. Mr. Johnson?
No by proxy.
Mr. Johnson, no by proxy. Mr. Reed?
No.
Mr. Reed, no. Mr. Schumer?
No by proxy.
Mr. Schumer, no by proxy. Ms. Lincoln?
No by proxy.
Ms. Lincoln, no by proxy. Mr. Leahy?
No by proxy.
Mr. Leahy, no by proxy. Mr. Harkin?
No by proxy.
Mr. Harkin, no by proxy. Mr. Shelby?
Aye.
Mr. Shelby, aye. Mr. Crapo?
Aye.
Mr. Crapo, aye. Mr. Corker?
Aye.
Mr. Corker, aye. Mr. Gregg?
Aye.
Mr. Gregg, aye. And Mr. Chambliss?
Aye.
Mr. Chambliss, aye.
Clerk will report.
The vote are 5 aye, 7 nay. The measure is not passed.
Are there further amendments to be
Mr.
voted?
Chairman.
Senator Chambliss.
Mr. Chairman, last Thursday, the House stripped and the Senate accepted stripping a provision in the margin section of Title VII that stated any transaction involving an end user would be exempt from the margin requirement. Now, even if a transaction is not required to be cleared due to the fact that an end user is one of the counterparties, their dealer counterparty is going to be subject to posting margins for this uncleared transaction, which in turn is going to mean that a dealer counterparty will pass this margining cost on to the end user. The end user avoids posting margin to the clearinghouse, but is going to be forced to pay the increased cost of margining anyway. Now, under the Senate bill provision, which was stripped, they would have been assured that there was no margin requirement for their transaction on either side of the trade, and thereby no margining costs, which is the whole point of the exemption from clearing. Now, this is an unintended consequence, I think, of something that happened at the last minute. I have an amendment, which I would ask the clerk to pass out, that would cure this problem and that would ensure that no end user that is declared as exempt is going to have to post margins, which was the original intention. It was in the Senate bill originally, and that's what we all intended to have take place, and there was no discussion about that provision in the amendment that was ultimately accepted in the conference, by the Senate in the conference and sent to the House. So I would ask consideration of my amendment and vote in support thereof that will fix this problem that none of us intended to have take place.
Senator, let me think, and we spent a lot of time today talking about this, and there is a difference of opinion on how clear the language is. Our consideration, based on conversation we've had, is the language is clear. But what I've offered to do on this, because opening up this, we want to keep this, coming back to this conference, strictly focused on the pay-for provisions. But I've suggested that a colloquy on the floor of the United States Senate, and might invite a similar colloquy on the floor of the House, it's up to the members obviously to decide, to clarify what we believe is the clarity of the language.
Senator, if I might just procedurally, I move to reconsider the title that included the pay-for. And on our side, that's the only thing that's now open. Someone, when it comes back to us, might move reconsideration of another title. We closed all those titles and voted to do it. It would be my intention to vote against reopening any other title. So at this point, the House is not procedurally open to accepting any other title unless someone moves reconsideration. And because I believe if we were to begin to redo the whole conference, we're back here for a much longer time. But anyway, procedurally, we are not prepared to accept offers on any other subject.
Understand that. And again, I'd say to my friend from Georgia, I think we can help clarify this language to the appropriate place.
Well, I appreciate your offer to help clarify it, but the problem is that a colloquy on the floor is not going to help us if the statutory language is clearly in the other direction. And this again, Mr. Chairman, and I think while I appreciate your folks having looked at it, the financial community is up in arms over this, and rightfully so, because I happen to think that end users are going to be required to post margins by this, and that was not what we intended. And it's one of those additional provisions and one of those expenses, Mr. Chairman, that is going to have the result of driving more and more of these transactions offshore, put them back in the dark. That's not what any of us want to do. But it's a provision that is going to have serious consequences to end users that we thought we were treating properly.
Yeah, let me just, look, again, I said to my friend from Georgia, we disagree about this. I might urge, by the way, we think the clarifying language in a colloquy can help alleviate the concerns that people have raised this issue as we examine the issue today. Let me just say that had I felt there was legitimacy to what's being offered here, I might have suggested that we deal with this, but we're satisfied it's not a problem. But I might also suggest that by pursuing a vote on the matter, we end up with a recorded vote on this matter. It's not going to help the legislative history. In fact, confirming exactly what I believe to be the case, and that clarifying colloquies can help. So again, it's up to members, obviously themselves, whether or not they want to pursue it, but I would strongly recommend that you let us try and deal with this in a way that will satisfy what I think we all agree on. It was not designed to subject literally all of these individuals, organizations to have to meet margin requirements. But nonetheless, I'd recommend we go that route rather than voting on this matter and doing damage, I think, to an otherwise an issue that I think we can help.
Well, Mr. Chairman, you've had the votes all along anyway, so I'm sure I know what the outcome would be, and I think I would want one. What I would prefer would be that you accept it and that the House make an exception and take this one clarifying provision, because if we don't, it's going to have consequences that neither the House nor the Senate intended to have in the most complex and the most controversial and the most discussed and debated provision or title that we had in this entire bill. And while I appreciate what Chairman Frank said, I don't think he wants this to happen. I don't think he wants end users who are exempt to post margin requirements. That was never discussed, and I think it's a huge mistake for us to do otherwise, Mr. Chairman.
I thank my colleague. It's up to him to pursue. You want to pursue the vote, or do you want to?
Yes, I'd ask for a recorded vote.
All right, clerk will call the roll.
Mr. Chairman?
No.
Mr. Chairman, no. Mr. Johnson?
No by proxy.
Mr. Johnson, no by proxy. Mr. Reed?
No.
Mr. Reed, no. Mr. Schumer?
No by proxy.
Mr. Schumer, no by proxy. Ms. Lincoln?
No by proxy.
Ms. Lincoln, no by proxy.
No, wait a minute, I'm sorry. Let me. Aye by proxy. I'm Senator Lincoln's aye by proxy.
Senator Lincoln, aye by proxy. Mr. Leahy?
No by proxy.
Mr. Leahy, no by proxy. Mr. Harkin?
No by proxy.
Mr. Harkin, no by proxy. Mr. Shelby?
Aye.
Mr. Shelby, aye. Mr. Crapo?
Aye.
Mr. Crapo, aye. Mr. Corker? Mr. Corker, aye. Mr. Gregg? Mr. Gregg, aye. And Mr. Chambliss? Mr. Chambliss, aye.
Clerk will report.
Mr. Chairman, the vote is a tie, 6-6, and the measure is defeated.
Fine. Let me suggest we're going to take a 5-minute recess for a minute.
We take a brief recess.
Yeah, exactly. Right. Right. That's right, exactly. Right, the fear. What they're afraid of, what they want. Right, is 100% guaranteed. No, they want to be able to say they can't pass any course on of compliance or anything else. Right. Or they can, but they can't claim it because of the margin they have to put up. Right, exactly. And, so their margin is based upon, frankly, their margin is based upon what?
Senate conferees will come to order. If I can. Let me say that the previous vote we had on a tie vote and the proposal failed on a tie vote. I want the record to reflect, as I expressed to Senator Chambliss, I believe the problem isn't as pronounced as my colleague from Georgia would suggest. But I think it's important to note that while I don't necessarily disagree with what he's suggesting on this, I thought the colloquy would solve the problem. That the fundamental reason for the vote on this side is less to do about the substance of the thing than the fact of the matter is that we've got a limitation here on the parameters of this conference to be focused on the title that deals with the pay-for provisions of the bill. And that I'm prepared to work with my colleague from Georgia, as others would be, to see if whether the colloquy solves the problem or something else may be done. But
Senator,
the point is we just open up.
and as I said, in the procedural footing, I hope to not vote to reconsider any of the title, but this is a very large bill. I believe we will need a technical corrections bill that goes beyond just minor things. And there are people on the House side who are also into that same point. I am not prepared at this point to say exactly how I think it should be resolved, but I am committed to a bill subsequent to this on things that are not terribly controversial. And I think once we've got the whole bill done, there becomes a mutual interest in technical corrections and clarifications, which we would follow up on. And I would certainly agree that this subject matter should be in such a bill. But if we were to reopen the conference now on other issues, I believe the thing unravels.
Well, I appreciate the comments of both chairmen. The only thing I would say is that this is not a technical amendment. This is a very, very substantive amendment that is going to be very expensive on end users.
Senator, I shouldn't have said technical. I said it's a correction, because what he's saying is that it wasn't what was intended. And I believe there will be the need for a bill that makes corrections. We have a wonderful staff, but under the most adverse conditions, they did an extraordinary job, but it won't have been perfect. So I strike the word technical. I believe we will need to do some corrections, both literally corrections, but other things where we think about it and say, well, maybe that doesn't work so well. So I think that there was something of this magnitude. There will have to be a second, smaller bill on things that are not as controversial within the context of the overall bill. But I'm not prepared.
Let me also suggest, and again, the title, this title in the bill doesn't go into effect for 1 year. And so there's going to be the time as well to examine whether or not the colloquy would solve the problem or something more may be needed. I'm not arguing about whether or not my colleague is right about that more may be needed than a colloquy, but we have a window here, it seems, to address this as well without opening up the entire bill as well. So he has my commitment that I'll try to work with him in a way that solves this problem.
Well, I thank both of you for your willingness to at least us try to fix it.
Without now, the motion is on the Senate proposal as the alternative for the pay-for that the clerk has at the desk. Clerk will call the roll.
Mr. Chairman.
Aye.
Mr. Chairman, aye. Mr. Johnson.
Aye by proxy.
Mr. Johnson, aye by proxy. Mr. Reed.
Aye.
Mr. Reed, aye. Mr. Schumer.
Aye by proxy.
Mr. Schumer, aye by proxy. Mrs. Lincoln.
Aye by proxy.
Mrs. Lincoln, aye by proxy. Mr. Leahy.
Aye by proxy.
Mr. Leahy, aye by proxy. Mr. Harkin.
Aye by proxy.
Mr. Harkin, aye by proxy. Mr. Shelby.
No.
Mr. Shelby, no. Mr. Crapo.
No.
Mr. Crapo, no. Mr. Corker.
No.
Mr. Corker, no. Mr. Gregg.
No.
Mr. Gregg, no. Mr. Chambliss.
No.
Mr. Chambliss, no.
Clerk will report.
Mr. Chairman, the vote are 7 aye, 5 nay. The measure is passed.
With that, we send to ask the yeas and nays, and with that, we send this proposal to the House. All those in favor of sending to the House say aye. Those opposed, nay. The ayes appear to have it. The ayes have it, and the amendment is sent to the House.
Under my reconsideration, this title is now open. I move that we concur with the Senate, and I'll recognize the gentleman from Alabama.
Thank the chairman. Chairman, we convened at 5 o'clock. We got a 3-minute notice as to the amendment, but it was not 3 minutes before the meeting. It was 3 minutes after the meeting started. Here's the email, and I'd like to put that in the record. And it's from the email where we got all the amendments. And it's 5:03, and it says, attached is a copy of the amendment that will be offered at today's conference meeting, which is sort of another illustration that this bill is not getting due consideration. We've all been out on the highway and seen an 18-wheeler that's swerving from lane to lane, and we say that driver hadn't had any sleep in 16 or 20 hours. Well, you know, last Thursday and Friday had a lot of weaving. And as Senator Chambliss said, part of the weaving is going to cost American companies as much, and I have an estimate of $1 trillion on the derivative pursuit. That's money that won't create jobs. Now we're hearing that we're going to declare martial law. Now, what's the last time you heard that? It's the health care bill. A lot of similarities between this bill and the health care bill. We hadn't declared martial law since then. So when the votes are there, it goes out on the floor. Beyond that, Senator Gregg and several other, Senator Shelby, have talked about this idea of how you pay for it. And in this bill someplace, and I'd like for Chairman Frank to show me where it is. There's got to be a magic trick in there. Because you, and Senator Dodd, you said we're going to pay for the cost of this legislation and return it to the taxpayers at the same time, and then you said ultimately. Now, how do you pay for the programs under this legislation, and then suddenly that money disappears, it's spent, and then suddenly it just magically reappears, voodoo? It appears out of nowhere, and you return it to the taxpayers? I mean, I got to see that. I've never seen such a thing as that in my life. And when we get through debating the main amendment, I plan to offer, make a motion to reopen Title VII. We've reopened 2 titles, we reopened 13 and 16. And when I do, I'm going to discuss what the associations are saying about how much this is going to cost job creation. And that's what, Senator Dodd, you and I think everybody on both sides of the aisle, we agree jobs are the most important issue. Creating jobs, putting people back to work, keeping people at work. And that's what Senator Chambliss's amendment was about. I've got several questions. I thought maybe that the staffer was going to answer it. You know, Senator Gregg asked your staffer to explain the savings to the conferees. And what he said is the provision of the amendments have savings, and he talked about this provision saves this much and this provision saves that much. But he never told us how that was going to happen. I've got all kind of questions. One of the things we keep hearing is that you're going to shut down TARP and all its programs. And I'd say, are you going to end the capital purchase program? Can somebody just give me a yes or no on that? Or we're going to end the capital purchase program? The homeowner assistance mitigation program, which we stepped up, we actually added more money to that, or my friends on the majority did. Is it going to end the homeowners assistance mitigation program? How do you shut down a program 3 months early and that suddenly saves you $10 or $15 billion? I mean, were you anticipating in the last 3 months of the program you were going to lose $15 billion somehow? I mean, I think these are all legitimate questions. I'd like Chairman Frank, and folks say he's one of the smartest guys in this Congress. I'd like him to answer these questions.
Gentleman's time has expired. I can tell time. I'm not sure how much smarter I'll say than that. Is there further debate? Gentleman from California.
Let me make the point that this bill, in large respects, will restrict access to credit. And that is one of our key concerns about this provision. Adding another assessment by the FDIC is going to further compound that credit contraction that we're experiencing. And I think for all of us who've been talking to small businesses in our district that are worried about working capital, worried about how they're going to handle their payroll or maybe expand, right now to do that seems like a real step in the wrong direction. Second, with respect to TARP, I opposed TARP, and a lot of us did when it was initially constructed, because of the strong suspicion that it would turn into an endless gravy train. And I think what we have learned through this process in watching it pay for additional spending is just that. On the Democrat side, we had an initiative for a while that the majority was pushing for TARP funds to go into the Affordable Housing Fund. I'm sure that will be back. Once you start down this road, it is very, very hard to get back on the correct path. And we incur all of these costs in this section of the bill for what? Well, in one sentence, in terms of moral hazard, We continue to expose taxpayers by codifying the too big to fail status for certain select Wall Street firms and offering public monies as the initial source of funding to bail out the creditors that are funding those firms. Next, I would point out that those who are making the argument, the folks that are telling us that this is a pay-for, were the same folks telling us TARP would be repaid to the American taxpayers. And I would point out at the end of the day, I think we know that that is not going to happen. And lastly, if you think about it, this is eerily reminiscent of the accounting gimmicks used to pass the health care bill. Congress took tens of billions out of an insolvent Medicare program to appear to pay for a massive new entitlement program. Well, we're going down that road again, and as I explained, to what end? Because at the end of the day, the bill creates the illusion of safety, but by compounding moral hazard with this virtually unlimited government guarantee or backstop, we're going to further undermine market discipline. We have a situation today with 45% of the financial system has a government backstop. That number is going to go up to 60%. It's going to be $25 trillion. That's a majority of our capital market that's going to have the government standing behind it. There's a lot of moral hazard with that. Again, we had an alternative, and I'll close with this. It was to allow bankruptcy, the regular bankruptcy process, but to beef it up, to have an enhanced bankruptcy where we put in the courts the ability and the objectivity, frankly, to handle these types of situations and wind downs just as they do with bankrupt railroads or airlines, and I think it would have been a much preferable course. Thank you, and I yield back, Mr. Chairman.
Thank you very much to both Chairman Frank and Chairman Dodd. I respect the hard work and the long hours that you have put in to trying to come up with reform in this financial services community, regulatory reform that would benefit the people of this country. I know that you've worked hard, and I respect that. I am like Senator Reid. I really did like the proposal that would tax the too big to fail banks in order to pay for any resolution that would have to be done at some point in time. And I'm sorry that we gave in to the Senate and that proposal got lost, and we ended up with something that supposedly was targeted to reducing the deficit some 25 years from now or something. I'm concerned about the foreclosure crisis in this country. I know it may not be a popular thing to talk about because there are those who would have you believe that everybody that's in a foreclosure crisis or this mess that has been created is the fault of the homeowners. There are those who would have you believe they were trying to game the system. There are those that would have you believe that they were just plain old irresponsible. What they cannot explain is why all of this happened at a certain period in time and why so many homeowners all across this country, north, south, east to west, all of a sudden ended up with mortgages created by exotic products by the banks, and why it happened, when it happened, and how it happened. Of course, I don't believe that the homeowners, those people who were trying to realize the American dream, were simply trying to game the system. What I believe is that major financial institutions and loan initiators in this country created these no-doc loans, these liar loans, these adjustable rate mortgages, and every other kind of exotic product that you can think of in order to get people to sign on the dotted line with mortgages they didn't understand, and certainly when the devil came due, they were not able to pay. And so I believe that the taxpayers of this country and those homeowners, would-be homeowners, those people trying to realize the American dream, need some protection by the public policymakers that they send to Washington, D.C. To look out for the interests of all of the people of this country. I don't think we've done a good job of it. I don't think the HAMP program is working. Let me just give you some facts. 2.8 million homeowners received a foreclosure notice in 2009. There were 323,000 foreclosure filings in May of 2010, which is virtually identical to the filings in May 2009. Per the Congressional Oversight Panel for TARP, Treasurer's response continues to lag well behind the pace of the crisis. As of May 2010, only 350,000 homeowners have received final 5-year loan modifications, a small fraction of the 6 million borrowers who are presently 60-plus days delinquent on their loans. The Congressional Oversight Panel for TARP notes that for every borrower who avoided foreclosure through HAMP last year, another 10 families lost their homes. The Congressional Oversight Panel says that only 275,000 households will ultimately avoid foreclosure because of HAMP. Let me quote, "It now seems clear that Treasury programs, even when they are fully operational, will not reach the overwhelming majority of homeowners in trouble. Treasury's stated goal is for HAMP to offer loan modifications to 3 to 4 million borrowers, but only some of those offers will result in temporary modifications, and only some of those modifications will convert to final 5-year status. Even among borrowers who receive 5-year modifications, some will eventually fall behind on their payments and once again face foreclosure. In the final reckoning, the goal itself seems small in comparison to the magnitude of the problem." This is by the Congressional Oversight Panel for TARP. Now, when I look at this proposal that you all have brought us, it basically says no authority under this act may be used to incur any
Gentlewoman's
obligation.
time has expired, so another member will be able to get some time as we go forward. Is there further debate? Gentleman from Texas.
Thank you, Mr. Chairman. I don't suppose this rises to the level of the Cornhusker kickback or the Louisiana purchase. But for us to have received roughly an hour, if not less, notice about this conference, to receive an amendment that is core to this entire legislation, how you pay for it, and to receive that at 3 minutes after the conference was reconvened on an amendment that I believe is fundamentally deceptive to the American people, is fundamentally unfair. I don't understand, again, how pots of money can be used for two different purposes. I've heard the distinguished chairman of the banking committee staffer say that CBO has said this and CBO has said that. They're good people at CBO. They score what you put before them. If you don't put before them that you're going to use the same pot of money for two different purposes, well, that might alter the score. And I've heard CBO discussed. I haven't seen an official score from CBO in this new proposal. So if one exists, I would hope that someone would make it available to those who are conferees. Now, I've heard the chairman of the Senate Banking Committee said, well, this will end TARP. Well, I guess it's a tacit admission that TARP shouldn't have been extended in the first place. Myself, a number of us have had legislation that would have terminated TARP long ago. But number one, I'm not really sure this terminates TARP. Again, we have existent programs. It doesn't say they're going to end the funding. It just says you can't add new programs. And with respect to bringing the ceiling down, there's still language in the underlying bill that says as long as the Secretary of Treasury can get the Fed chairman to agree with him that he's got some very important purpose, well, all of a sudden he can go back up, raise the cap. I don't see this terminating the TARP program. But more important than that, the American people were told this money was going to be used to reduce the deficit, a deficit that has increased almost tenfold in the last 2 years, that has contributed to the largest debt in the history of America,
where now we're at a tipping point of having our debt be 90% of our economy. Greece is about 113%. They're having to sell sovereign territory to pay their debt. And here we are taking money away from the TARP funds. I don't understand it, and telling the American people that somehow by magic it's going to be used for two purposes. And now the DIF. You know, these are funds, already we know that the deposit insurance fund is stressed. So on the one hand, we say we're going to add to the deposit insurance fund. This needs to be done. This is important to shore up, show signs of strength. But on the other hand, you know, I've got at least an earlier CBO letter that says this legislation is going to increase direct spending by $26.9 billion. And so we're going to use that revenue for a pay-for, which, by the way, in this Congress, is obviously the pay-for is the last thing anybody ever thinks about here. It's kind of the afterthought. So we're going to use it to shore up the fund, but we're going to use it as a pay-for. You know, isn't it interesting that we're writing into this bill an office that supposedly is going to root out abusive, unfair, and deceptive financial practices, which is exactly what this pay-for is. The very first thing that this CFPB ought to do is outlaw this funding practice. It is unfair, it is abusive, it is deceptive. This is the kind of accounting that would make Bernie Madoff blush. And here we are, members of the United States Senate and House, getting ready to pass this. I don't understand it. And by the way, it's still a tax. Maybe it's a tax on different banks, but it's still a tax. It's a tax that ultimately is going to lead to less credit, more expensive credit, and fewer jobs. That's what this is all about. I yield back to balance my time.
Further debate on the question, gentlewoman from Illinois.
Thank you, Mr. Chairman. I too am concerned about the fact that we did not receive this amendment when the meeting had started. And I can remember when TARP first came up in the House, and the first bill really didn't have the accountability, and most all of us voted against it. But then there was this crisis that if we didn't, the market was going to tank and we would never recover. And I can remember calling Senator Gregg about that and saying, how are we going to ensure that there's accountability? And what he said was, the money that comes from TARP will definitely go to the debt. And so I think we've always counted on that, and many of us voted for it for that reason. But now we're going to say, well, the TARP money is going to pay for this bill, and it is. What worries me is Pete Peterson Foundation, Dale Walker, was at a hearing that we had on the Oversight and Investigation Subcommittee. And he said that we are at a tipping point, and we have 1 to 2 years to solve this problem of our debt. And the first thing that we have to do in order to solve that is to tell the truth to the American people, that they have been lied to, and that we're going to have to do sacrifice. Not only the American people are going to have to sacrifice, but the Congress is going to have to sacrifice and stop spending. And this is just changing, it's still going to be $19 billion that is going to increase our debt at the least. And then I think we have this problem with the end user, which we'll get to, but this concerns me that when we know that something's wrong, we should do the right thing. And to say, well, we'll do it maybe in a colloquy, or just trust us, we'll fix it later. I don't think that people want us to vote for a bill that is not the way that it should be, and just to pass it over and say, I don't think we just can't do that type of thing, and I would yield back.
New Jersey.
I thank the chairman. You know, I think it was around 6 o'clock in the morning on Friday that the gentleman from Pennsylvania made the official or semi-official motion that we should rename the bill to the Frank Dodd bill. And I think after what we've just seen, after all those days and hearings, and even more so now, you just sort of combine the Frank Dodd to the fraud bill to describe exactly what we have here now. Because it amazes me, in this day and age, when our constituents at home are going through such hard times and asking for Congress to do the right thing in general, smaller government, less spending in government, and that's what Congress is tasked for, here we end this bill process with doing the exact opposite: larger government, increased spending, and increased taxes. Now, I know the good senator said a couple times, there is no other way. There are no other alternatives. We're in a catch-22. Really, Senator? There's no other way? Wouldn't it be novel if just once from the majority party that we would hear the idea of cutting spending, reducing spending, finding some offset someplace? You know, in my state of New Jersey, if you read the paper just this morning, we did just that. And we did it in a bipartisan manner. We took Governor Chris Christie, reaching across the aisle, took a 30-some-odd billion state budget. So, Senator Gregg, what's the size of your budget up there? It must be a lot smaller than that. But we have a $30 billion budget, reduced spending by $11 billion, some 9-point-something or other percent over time, in decrease in spending, bipartisan, without any tax increases like we're talking about here. And now the American public, and certainly the people from New Jersey, says, can't you do that here? And the answer from the majority party, from both the House and the Senate, is no. And all they ask is, really? You can't do any better? Now, the senator also brings out the letter from the FDIC with their comments with regard to the raising of the money. And it sort of makes with the raising of the DIF from 1.15 to 1.35. Well, if you read that letter, Senator, what the chairwoman was saying, and I just had a nice conversation with her earlier today, actually, on another topic, as you can probably imagine. But she points in here, they were already planning on doing that. Maybe not up to 1.35, but the letter that you referenced, and you didn't, we just got a copy of here, says the reserve ratio already needed to be increased to, and they were aiming towards 1.25. So the idea that, you know, they're supporting this idea of going to 1.35 as a funding mechanism for this is not really here in this letter. They're just saying that in light of the crisis, in light of all the facts that out there already, they recognize the need to strengthen the FDIC. So I don't think the letter really supports the argument that you're making that we need to be raising taxes. And if it did, think about it. Where is this FDIC funding increase actually going to go to? It's going to go to depository institution, is it not? It's not going to go to all the non-depository institutions, unless the majority is going to suggest that we're going to start taxing banks now to fund non-depository institutions. And that would raise a lot of concern, I think, from our local bankers back at home. They're not suggesting that, but that is, again, another budgetary gimmick that we see in the language here. And finally, to the point of the CBO scoring. While I did appreciate it and found it quite interesting on our last night here, where it was actually the Senate staffers from the majority who were sort of running the show as opposed to the majority staff, as opposed to the senators themselves, we find ourselves in the same boat today, that we are relying on staffers as opposed to actually written documentation. We've been here for almost an hour and 45 minutes. I am still looking for that proverbial CBO scoring in writing to document exactly where the money's coming from and where it's going to, and we still don't have it. To ask any of us on either side of the aisle, in either the House or the Senate, to be voting on such an issue of such magnitude without that documentation, but instead to be relying upon Senate, is troublesome. And so to go back to where I began, the appropriate name for this bill is probably the Frank Dodd bill combined together. And to the constituents back at home, the question that they have, can't you do anything better than this? And my question is the same. Really, Senate? Can't we do better than what you're suggesting here today? I'll yield back.
The gentlewoman from West Virginia.
Thank you, Mr. Chairman. I'd just like to make two brief points. one of which is on the FDIC increase in the percentage. First of all, just having found this out, discovered this as we walked in here today, I don't think any of us have had a heart-to-heart with our community banks and other banks in our regions to find out what this really means to them. I don't think we've had time to have a reaction because we haven't had time to really share this information. And the chairman, Chairman Dodd, said that he's exempted out community banks, $10 billion and below will not be affected by this. But over the life of this bill, maybe you're not affected by it today, but you could be if you grow and do the right thing. Your institution grows to $10 billion and over, you're going to be affected by it, not in maybe 2 years, 3 years, 4 years. So more and more financial institutions, hopefully, if we're not disincenting growth here in the financial institution, the banks, are going to fall into this tranche. And so more and more of our community bankers and local job producers and small business small business loan folks are going to be falling into this. I don't know about you, but I've had several meetings in my office where community bankers and others have come to my office over the last 3 years and are straining under the cost of the FDIC fees and the special assessment that they just had over the last year. It's been a difficult thing, I think, in difficult times. And so I do question that and question the overall effect of that. But I guess the most frustrating thing for me here, since the bankruptcy portion of our proposal, I handled most of that, or a lot of that, on our side, along with my fellow Republicans. We didn't look closely enough at that, because I don't think we'd be in this position right now if we said to ourselves collectively that let's not say that government's going to have the right solution and know the wind down and know the way to solve these problems. Let's enhance something that we know works for companies and cities and airlines and others. The bankruptcy provisions through our court systems that provides the objectivity and the expertise that we see in all other forms of financial distress. And I think had we given a serious consideration to that and really looked at the way we needed to flesh out the bankruptcy code, I think we would have alleviated the problem that we're having, that you're having, really, is to come up with $19 billion. And I think we would have also created that barrier between the government solution and the court solution, the objectivities of the court, that I think would have probably brought us to in my opinion, a better solution, and one that I think would alleviate for all times any kind of obligation that taxpayers may have now and in the future. Thank you.
Gentleman from California.
I thank the chairman. I've tried to stay mostly out of the financial part of this, but I think with this pay for, I would like to make a small point, and that is that I know much has been said by the members of the committee about the various programs that will not go away as a result of, quote, ending TARP. I might note that if you're looking for a pay for, under HAMP, a program that has been through hearing after hearing in my committee in government oversight on a bipartisan basis, is a program that has had a very hard time continuing to be important. It was important. It stabilized the market, but today 80% of the loans at Wells Fargo and similar figures at other firms are going on without and outside of that program, and we have been told in sworn testimony that virtually no loans would ever disappear as a result because of the 31% requirement that's in there, loan to income. So we have an opportunity to look at a program and at least trim some of the money there. And I might note that you could trim it without taking TARP funds, because in the HERA, the Housing Economic Recovery Act, there was $25 billion. Because so little has been used by that program, you have a substantial amount of money that, in fact, would be a legitimate pay for with previously appropriated funds in 2008 that are excess. I might suggest that. Additionally, Mr. Chairman, I have a quandary question for the chair. On the first day, I offered the first of what was to be many amendments related to transparency, data standards, about as boring and technical as you could be, but something that has already been approved by the House and other means that seemed very appropriate to put in here. You quite candidly did the right thing, which was you said, look, why don't you work with us and let's see if we can't come to fair meetings on all the details. We worked in good faith, your staff worked in good faith, and we reached, along with the administration, all of the regulators, we reached 26 pages, 200-plus markup that was acceptable at least to House Republicans and Democrats and to the administration. It went to the Senate, and when I've asked the Senate, what happened? How did it just die? I can't even find somebody who says, I didn't like it, there was something wrong with it. Now, I know that that is not per se part of what is open for debate. But I would like to inquire in the sense of transparency of this process, aren't we entitled to at least understand what was wrong with it in a way that we could work on future?
Gentleman would yield?
Of course, Mr. Chairman.
I have searched every document open to me. I have not found any mandate that I'd be able to understand what happens in the Senate. If the gentleman finds one, I'd like him to share it. I will say to the gentleman, all we can do, that's the conference process. I'll say to the gentleman, we did get agreement. I will commit to him that since that's within the to the extent that it's within the jurisdiction of the Financial Services Committee, and it may be shared with the Government Oversight Committee, we'll have a separate markup on that, send it to the floor on suspension, and try again. That's as best we can do.
I appreciate that from the gentleman, and not being knowledgeable of all the intricacies of the pay-fors, I appreciate him bearing me out in at least my offering an alternate. I have no amendment on that. I think it's outside of government oversight to formalize it. But I would like to suggest that if this does not pass with the pay-for that seems to be so controversial, you might caucus with your members to see if in fact, an actual fund of money could be used, which would still leave a substantial amount of money in the HAMP program.
I now recognize myself for 5 minutes to begin by saying I think there's some merit there. Look, the gentleman from California is absolutely right. We have not done nearly enough from the beginning of this program to alleviate the distress of average citizens that was caused by these problems. We did put in the bill $4 billion to try and deal with it. It was cut in our negotiations to $2 billion. I intend to press for more. And gentlemen are right, the TARP is not ended by this program. It says no new commitments are there. There is some money left unobligated, and I intend to press for some more that would go to effective programs to aid people. For instance, those who are unemployed. You can argue about people who did or didn't take out a loan where they didn't document it. But certainly people who are unemployed ought not to be treated as if they were somehow perpetrators of a scheme. And I would say, and I just comment to my colleague who's been a leader in this, the gentleman from California, that maybe some of the HAMP money ought to be reprogrammed for something else. But now, as to this particular provision, first, I am sorry it wasn't made available earlier. We didn't get it until just before we shared it. This was a Senate amendment. And I would also say I preferred what we did in the bill. I preferred asking Goldman Sachs and J.P. Morgan Chase and John Paulson's hedge fund and all of those others, hedge funds above $10 billion, banks and investment houses above $50 billion, to be assessed to the tune of about $19 billion over 10 years, about $1.9 billion a year, less than their bonus pool. And people who have not shown any concern about the size of the bonus pool suddenly decided that fairly small amount, in context of what they make, would somehow drive up ATM fees and would be wreaked on the consumer. The answer to that, in part, is no, not entirely, because we have a consumer bureau in here, over the objections of many, that will protect consumers from being unfairly levied upon by that. So I much preferred what we did, and I do not understand why some members on the Republican side, none of whom are here, preferred what we are now being talking about to levying a financial hit on these big institutions. I will say this. The FDIC fee, the way we have it in this bill, does hit the larger institutions, not simply because there is the cutoff under $10 billion, but even more because on the initiative of the gentleman from Illinois, Mr. Gutierrez, and in the House, working with Sheila Bair, we have mandated the FDIC to do what it is very eager to do, put a risk weighting into the assessment. So it is the larger, riskier, less risk-averse institutions that will pay more under the FDIC. So if our bill passes, smaller institutions will be advantaged. So I regret the fact that we are making the change. But the fact is, apparently, and these are important considerations, to get enough votes to pass this bill, we have to do this. And it's a very important bill. There is a consumer agency in here. There is regulation of derivatives. Paul Volcker, who didn't get everything he wanted because nobody gets everything he wants, is a strong supporter of this bill. Mary Shapiro at the SEC is a strong supporter. I was struck by the Time magazine's cover of the 3 new sheriffs in town, who were Mary Shapiro, Elizabeth Warren from the consumer advocacy side, and Sheila Bair, all strong supporters of this bill. Securitization, risk retention. There are a number of very important things in this bill. Giving the SEC the power to adopt a fiduciary requirement for people who sell retail. A fiduciary requirement for municipal advisors, so that we don't get the kind of problems we've all seen in various municipalities. All those are very important in the bill. I'm prepared to make some compromises to get this very important bill through. And by the way, for those who worry about us getting too far, I was pleased to note that the Conservative Party Prime Minister in Canada, Mr. Harper, said over the weekend that with this bill, America takes the lead in financial regulation and the rest of the world will follow. So I accept this. By the way, on the TARP, what it says is this, and I prefer the original way, but what CBO was saying is this. And there were two things. The gentleman in New Hampshire made the distinction. Money repaid to the TARP goes into the Treasury, and we have made a profit on the bank part, not on the automobile and AIG part. What CBO is saying is that if you spend the remaining unallocated TARP money, you will lose some of it. You won't get it all back. And that's how they come up with the $11 billion. Now, I must say that CBO is a wondrous institution, and I often am puzzled by it. But I'm as often puzzled on the plus as on the minus. And I do know that my colleagues have a tendency with CBO, as we tend to do with other things, to love it when it agrees with us and to not so much when it doesn't. But that's where we are. So given the importance of this bill, given that we can do more with unexpended TARP funds for mortgage relief for people who need it, I hope that we concur with the Senate. The question is now on concurring with the Senate. Those in favor will say aye. Aye. Opposed, no. The ayes have it, and it's adopted. We concur. The Senate, the gentleman from Alabama asked for a recorded vote. The clerk will call the roll.
Mr. Chairman.
Aye.
Chairman votes aye. Mr. Kanjorski. Aye. Mr. Kanjorski votes aye. Ms. Waters. Ms. Waters votes present. Mrs. Maloney. Aye. Mrs. Maloney votes aye. Mr. Gutierrez.
Who?
Mr. Gutierrez.
Aye by proxy.
Aye by proxy for Mr. Gutierrez. Mr. Watt. Aye. Mr. Watt votes aye. Mr. Meeks.
Aye by proxy.
Mr. Meeks votes aye by proxy. Mr. Moore. Aye. Mr. Moore votes aye. Ms. Kilroy.
Aye.
Ms. Kilroy votes aye. Mr. Peters.
Aye.
Mr. Peters votes aye. Mr. Backus. No. Mr. Backus.
No. Where were these guys?
Mr. Backus.
No.
Mr. Backus votes no. Mr. Royce.
No.
Mr. Royce votes no. Mrs. Biggert.
No.
Mrs. Biggert votes no. Mrs. Capito. Mrs. Capito votes no. Mr. Henserling.
No.
Mr. Henserling votes no. Mr. Garrett.
No.
Mr. Garrett votes no.
Clerk, please give us the results.
Mr. Chairman, on that roll call, there are 9 yeas, 6 nays, and 1 present.
And the House concurs. Are there further motions with regard to the titles that were reopened by the reconsideration? The gentleman from Alabama.
Mr. Chairman, I have a motion to reopen Title VII.
The gentleman from Alabama moves to reconsider Title VII. Did the gentleman vote for the title? Because only members who voted in the affirmative can move reconsideration. I must say I don't recollect that he did.
I think I voted that end users of derivatives wouldn't have to raise additional capital on
Then I think that means no. But I'll put the motion anyway. Those in favor of reconsidering, it's non-debatable, to reopen another title and spend more time here. We'll vote aye.
Aye.
Opposed, no. No. The noes have it, and I believe the business of the conference.
Is that I was going to speak on the amendment.
Well, it's not debatable. We
It's
did
not?
not open the title. The
All right.
title is not opened.
I guess
I
I won't-
believe that the business of the conference is now concluded. I'll yield, Senator. Well, we know we revote on the conference report. The clerk will call the roll on the House side. This is the conference report as amended. The clerk will call the roll.
Mr. Frank?
Aye.
Chairman votes aye. Mr. Kanjorski? Aye. Mr. Kanjorski votes aye. Ms. Waters? Ms. Waters votes aye. Mrs. Maloney? Mrs. Maloney votes aye. Mr. Gutierrez? Mr. Gutierrez votes aye by proxy. Mr. Watt? Mr. Watt votes aye. Mr. Meeks? Mr. Meeks votes aye. Mr. Moore? Mr. Moore votes aye. Ms. Kilroy? Aye. Ms. Kilroy votes aye. Mr. Peters?
Aye.
Mr. Peters votes aye. Mr. Peterson?
Aye by proxy. All members of the conference get to vote on this. Lucky for them.
Mr. Peterson votes aye by proxy. Mr. Boswell?
Aye by proxy.
Mr. Boswell votes aye by proxy. Mr. Waxman?
Aye by proxy.
Mr. Waxman votes aye by proxy. Mr. Rush?
Aye by proxy.
Mr. Rush votes aye by proxy. Mr. Conyers?
Aye by proxy.
Mr. Conyers votes aye by proxy. Mr. Berman?
Aye by proxy.
Mr. Berman votes aye by proxy. Mr. Towns?
Aye by proxy.
Mr. Towns votes aye by proxy. Mr. Cummings? Aye. Mr. Cummings votes aye. Ms. Velasquez?
Aye by proxy.
Ms. Velasquez votes aye by proxy. Mr. Schuler?
Aye by proxy.
Mr. Schuler votes aye by proxy. Mr. Backus?
No.
Mr. Backus votes no. Mr. Royce?
No.
Mr. Royce votes no. Mrs. Biggert?
No.
Mrs. Biggert votes no. Mrs. Capito? Mrs. Capito votes no. Mr. Henserling?
No.
Mr. Henserling votes no. Mr. Garrett? Mr. Garrett votes no. Mr. Lucas?
No by proxy.
Mr. Lucas votes no by proxy. Mr. Barton?
No by proxy.
Mr. Barton votes no by proxy. Mr. Smith?
No by proxy.
Mr. Smith votes no by proxy. Mr. Isa?
No.
Mr. Isa votes no. Mr. Graves?
No by proxy.
Mr. Graves votes no by proxy.
Clerk, may we have the results?
On that vote, Mr. Chairman, the ayes are 20 and the nays are 11.
Senator, the House has concurred with the conference report as amended.
I thank the House Chairman. The clerk will call the roll for the Senate to adopt the Senate conference.
Mr. Chairman.
Aye.
Mr. Chairman, aye. Mr. Johnson.
Aye by proxy.
Mr. Johnson, aye by proxy. Mr. Mr. Reed.
Aye by proxy.
Mr. Reed, aye by proxy. Mr. Schumer.
Aye by proxy.
Mr. Schumer, aye by proxy. Ms. Lincoln.
Aye by proxy.
Ms. Lincoln, aye by proxy. Mr. Leahy.
Aye by proxy.
Mr. Leahy, aye by proxy. Mr. Harkin.
Aye by proxy.
Mr. Harkin, aye by proxy. Mr. Shelby.
No by proxy.
Mr. Shelby, no by proxy. Mr. Crapo.
No.
Mr. Crapo, no. Mr. Corker. Mr. Corker, no. Mr. Gregg. Mr. Gregg, no. Mr. Chambliss. Mr. Chambliss, no. Mr. Chairman, the votes are 7 aye, 5 nay. The report is passed.
I thank the clerk. I thank our House conferees for the hospitality once again.
Senator, I now say once again with feeling, this conference is now adjourned.